It seems to me that what has hit the market over the past week, certainly since Powell's speech on Friday and probably in anticipation of that, is the following. The realization that a recession is coming. It is in the cards. That's why oil is down $5 a barrel today. That's why stocks are down and falling today as well. Agree or disagree?
Well, Tyler, I actually think it's probably more a story of the Fed, if you're talking about the weakness over the last week or so, than growth itself. I mean, if you look at, what's been rallying, I mean, it doesn't make a lot of sense that, interest rates would be rising significantly if people were starting to price in a recession. And if you look at Fed expectations out into next year, people are getting more aggressive on their expectations. But, certainly the Fed's not going to be getting more aggressive if we actually are, going into a deep recession. So I really think this has been more about a repricing of the Fed, than pricing a recession. I think that story may still be yet to come. I just don't think it's in markets just yet.
I think in a funny way, Dan, we're talking about the same thing here. In other words, the idea is that the Fed, as it aggressively tries to wrestle inflation to the ground, the understanding in the market is that the Fed is going to raise interest rates, and that hurts equities, but that the likely result of the kind of aggressive Fed tightening that we are seeing right now is a recession. Not that we're necessarily going into one imminently, but that one is going to be very, very hard to avoid as a consequence of what the Fed's doing.
Yeah, I mean, that's the tug of war that's going on in markets, Tyler, is that, people just can't figure out, whether they should be focused more on growth or the Fed. And now week to week, I think that story is changing. The reality is neither of those stories are going to be good for markets. Right. I think it's, in some ways, it's almost a lose-lose for markets here unless you see a drastic shift in either of those stories because, from my vantage point, the only two certainties for the rest of the year are that growth is going to continue to slow. And we think we will be in a profits recession, by early next year at the latest, and we think the Fed's going to continue to tighten. That combination is probably the worst combination historically for markets. So either way you cut it, whether it is the growth or it's Fed or it's both, that's not a great backdrop for markets.
Yeah, a profits recession is never a good backdrop for markets, I would say. Exactly, man.
So Dan, the real question is then how would you guide investors to look at profits and liquidity and the things that you think are important in the near term? How do you gauge balancing that against the prospect of how other companies have done in the past?
Yeah, I mean, first of all, I think that, the big debate happening within markets right now is, is the bear market over or is it not? And I think if you look historically, it's very difficult to make the argument that it's over unless you're going to see some major shift in either that profit story or the liquidity story, neither of which we see in the cards just yet. So I think to see a sustainable rally, you need to see one of those two turn. In terms of how you position for that environment going forward, clearly, I think it's too early, to jump into the markets with both feet. In fact, if you look historically at the history of bear markets, the history is very clear that it's actually better to be late than it is to be early when jumping back to the markets. Not only do you have better probability of success and better returns and lower downside risk, but more importantly, you have the benefit of more time to analyze the data that's coming in. Because unless you're looking at the data, it's just guessing.
How late is too late?
Yeah, so the analysis I'm referring to is we basically looked at 6 months early versus 6 months late, and by being 6 months late, you're generally right, about 70% of the time historically, and the only times where it didn't really work out was again in those scenarios where policymakers had pivoted and panicked because things were collapsing. Clearly, that's not the case. You're not seeing that panic from policymakers, and so it's hard to argue that this is one of those times where you should be early.
Shepard Smith here. Thanks for watching CNBC on YouTube.